Hi, this is Sandeep Kapoor. Today we are having a class of income tax. The today's topic is incidence of tax. Incidence of tax means the burden of tax. In the last class we have studied that how to ascertain the residential status of an individual or a company, or broadly we can say how to ascertain the residential status of a person. Because the burden of tax on a person depends upon his or her residential status. As far as the rules of income tax are concerned, the person can get income from two types or two ways. One type of income is called Indian income, another income is called foreign income. Here we are differentiating between Indian income and foreign income. Indian income means any income which is earned in India or received in India, means earning activity of the income or the received of income. Any one activity if happens in India, then this income is called as Indian income. Whereas the foreign income means an income which is earned and received outside India. That means income earned and received, both things happen outside of India. Nothing is happening in India. The following chart highlights the provision of tax incidence in brief. To ascertain the tax liability of individual on the basis of their residential status, we follow a simple rule. As we know, an individual can have three types of residential status, that is residential Indian, not ordinary resident Indian, and non-resident Indian. And we understood that there are two types of income, Indian income and foreign income. So this chart tells us how to do the treatment of each type of income. As far as Indian income is concerned, it is taxable. It has nothing to do with the residential status of a person. That is, it is taxable for residents also, taxable for not ordinary resident also, and taxable for non-residents also. Whereas the foreign income, it has something to do with the residential status of individuals. Foreign income can be divided into different parts. The first part is if business, controlled or taxable profession is set up in India, then it is taxable for residents, taxable for not ordinary resident, but not taxable for non-resident. Second part is if business, controlled or taxable profession is set up outside India, then it is taxable only and only for the residents, whereas for not ordinary resident and for non-resident it is not taxable. There is one more category in this, that if past foreign income brought in India during the previous year, means some person is outside the India and he is earning from several years over there, now he is coming back to India and bringing his past income to India, then it is not at all taxable whether he is resident, not ordinary resident or non-resident. In this way, we calculate the total taxable income of a person. This income may be different for resident, not ordinary resident and non-resident. To this concept we call it incidence of tax, that is the burden of tax. So it is very clearly evident that the burden of tax depends upon the residential status of a person. To make it better understanding, we will take an example. This is an example of Mr. Ram. He has certain incomes in a particular assessment year, that is 23-24. We will calculate his taxable income by assuming that if he is ordinary resident, if he is not ordinary resident, or if he is non-resident. So these are the different types of income he has earned during the year. Now to calculate that what is his tax liability, we will move for the solution of this problem. This is the calculation of income liable to be taxed in India for Ram for the assessment year 2023-24. The basic thing, we will create the format which we have seen earlier also, that is particulars, and then there are three types of residential status which we are assuming that Ram may either be resident or not ordinary resident or non-resident. Now from the question we will pick up the income one by one and make the treatment that whether it is taxable for resident, not ordinary resident or non-resident. The first income is salary received in India from a former employer in UK. So you can see salary received in India. What is the rule for Indian income? Whether you have received it or you have earned it in India, it will be treated as an Indian income, and Indian income is taxable for all the three types of residential status. Second is income from a tea business in Nepal being controlled from India. That is the first part of foreign income, that is business controlled from India. So it is taxable for residents and not ordinary resident, whereas it is not taxable for non-residents. Third type of income is interest on a company deposit in Canada. It is clear that it is a type of foreign income because it is in Canada, but there is a loophole that 1/3 of such income is received in India. So whatever we have received in India, it is income of India. It is Indian income. So 1/3 of the total, that was total interest amount was 30,000. So 1/3 is treated as Indian income. So 10,000 rupees are taxable for each of the residential status, whereas the 2/3 part, that is interest on company deposit in Canada, received outside India. So it is foreign income category B, which is taxable only and only for residents, because the company deposit in Canada means the control and setup of the business was also in Canada, not in India. Next point is profit from a business in Mumbai controlled from UK. Now when business is in Mumbai, that means income earned in India. That's why it is Indian income and taxable for all three types of residential status. Next is past profit from business in Tokyo remitted to India. This is the category C of foreign income. That means it is not at all taxable for any type of residential status. Income from property in India but received in USA. An income arise from property in India but received in USA. It is received in USA, it doesn't mean that it is a foreign income, because property in India, that means income is earned in India. So it is taxable for all types of residential status. Income from a property in London but received in Delhi. Now, income from a property in London, that means earned in London, but income received in Delhi, and Delhi comes in India. So income received in India, so it is Indian income, taxable for all types of residential status. Then income from a property in London and received in Canada. So it is clear that it is a type of foreign income, and it is a category B of foreign income where control and setup is also outside India. So it is taxable for residents only, whereas for not ordinary resident and for non-resident it is exempt. Income from a business in Zambia but controlled from Turkey. It is again foreign income, which is the category B type where business control is also in outside India. So it is taxable for residents and not taxable for not ordinary resident and non-resident. So when we compute the total, that what is the amount of income liable for tax in India, we find that it is 7,35,000 rupees for resident Indians, 4,55,000 for not ordinary residents, and same 4,55,000 for not ordinary resident and 4,45,000 for non-resident Indians. So this is the way we require residential status to decide the incidence of income. That's why the residential status becomes important, because when the status changes, the taxable liability also changes. For more practice, there is another example. You can solve this question to clear the concept. I am providing the answer of this question also for your practice. So this is the answer of this question. So that's all for today's class. Thank you.